Investors, welcome to the Fincards weekly deep dive. This week we're looking at Tesla. And if you don't know, this is the show where every Sunday we give you a deep dive into some stock. We'll go through the business, we'll go through the financials, we'll take a look at the Fincards stock card, and we'll just give you an idea of what you should look out for on the bull or the bear case. So Tesla just posted the first annual revenue decline in its history as a public company. Its earnings per share have fallen 75% over 2 years, with operating margins grinding lower every quarter. But yet the company is still valued at over $1 trillion and trading at a price to earnings north of 300, which by any measure is absurd for a business whose profits are going in the wrong direction. So I think that tension, that disconnect between what the financials are showing and what the market seems to be pricing for the future is really what makes Tesla the most interesting and probably the most divisive stock, not just of 2026, but probably of the last 6 to 7 years. Because either the market is seeing something that the income statement hasn't caught up to yet, or this same kind of overconfidence that burned Tesla shorts for 13 years now is finally running out of road. And those are very different outcomes, and the data actually gives you a case for both, which makes this a little tricky. So today we're going to go through everything: the card, the filings, the business, the headlines, everything that's dropped this week, the full bull and bear arguments, and then we're actually going to talk about what matters going forward. So let's get right into it. All right, to start, let's look at the Tesla stock card on our Fincards app. Tesla has a ticker of TSLA, which closed March 20th at around $365 and a market cap of $1.43 trillion. Depending on the day and the source, you'll see closer to $1.2 trillion. The 52-week range is massive, with a low of $113 to upwards of $500 per share. So it's been a very volatile ride over the past year. Now the financials are where it gets really interesting. The fiscal year 2025 revenue came in at roughly $94.8 billion, which is down about 3% from the prior year. And again, that's the first time Tesla's ever posted a full year revenue decline as a public company. On its own, 3% doesn't sound catastrophic, but it's the direction of the trend that matters here. And when you look at the earnings per share, the trend is much steeper. $4.73 in 2023, then 2.23, then 1.18 in 2025. That's a 75% decline in earnings per share over a 2-year stretch, while the stock has mostly held its value, which is how you end up with the current average price to earnings ratio of around 300. Now, operating margins tell the same story, going from 16.8% in 2022 down to under 10%, then even further under 5%. Return on equity has compressed from the high 20s down to under 5%. The one bright spot in the financial snapshot is that we see free cash flow has recovered from $6.2 billion for the year after a rough 2024, and the cash pile grew to $44.1 billion. So they're not exactly in a liquidity crunch, but the fundamental question the Fincards stock card raises is pretty simple. Why does a company with declining revenue, compressing margins, and shrinking earnings command a valuation that implies such massive future growth? And that's exactly what we're going to talk about. To really understand the Tesla debate, you have to understand the company's history, because Tesla has always been a story about what it's becoming rather than what it currently is. And that dynamic is more extreme right now than it's ever been. The company was founded in 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk led the Series A in 2004 and subsequently became the chairman. Then he took over as CEO in 2008, right in the middle of the financial crisis. Tesla went public in 2010 at $17 a share, which after the splits works out to about $1.13. The Roadster came first, then the Model S, then the Model X, then the Model 3, then the Model Y, and then the Cybertruck in 2023. And each of those launches genuinely was a bet the company moment. With the Model 3 ramp in 2018 nearly killing them, there was a period where Musk has publicly said they were weeks from running out of cash. He was sleeping on the floor of the factory along with other employees trying to get the production line working. And anyone who's followed this stock for a while remembers what that felt like. Today the company reports in two segments. Automotive is still the core, roughly 73% of the total revenue, and that includes everything from the Model 3 and Y, which are the volume vehicles, to the S and X, Cybertruck, and the semi-truck, which is entering production this year, plus the full self-driving software subscription, the Robotaxi service that they launched in Austin, and regulatory credit sales. The second segment is energy generation and storage, which is about 13.5% of their revenue, which is the Megapack for utilities, the Powerwall for homes, and the solar products. Services and other revenue fills in the rest. But the really important thing to understand about where Tesla is right now as a company is the company is explicitly trying to redefine what it actually is. In their Q4 investor deck, they describe themselves as transitioning from a hardware-centric business to a physical AI company. The idea is that the car business is the foundation, the thing that generates the cash and the data. But the real value creation going forward comes from autonomy, robotics, energy storage, and AI. Whether that narrative is actually supported by what the numbers show you today is, I think, the single most important question in the entire stock market right now, at least in the Mag 7. Because the answer to that question is essentially what separates the bulls and the bears. So let me lay out the strongest version of the bull case first, because there are actually some very compelling data points here that I think get lost in a lot of the noise within this valuation debate. Now, the energy storage business is probably the most underappreciated part of Tesla right now. Deployments grew 49% year over year to 46.7 gigawatt hours. Revenue was up 27%, and they posted their fifth consecutive quarter of record gross profit in just that segment. They're building new mega factories. Shanghai has 40 gigawatt hours of Megapack capacity online. Texas is under construction, and the global Powerwall network now has over 1 million installed units that collectively participate in 89,000 virtual power plant events in 2025. That's reportedly saving homeowners over $1 billion in electricity bills. So this is not a speculative side project anymore. This is actually a real business that's scaling fast with improving economics. And it's happening at a time where demand for grid-scale energy storage is accelerating because of the AI infrastructure build-out. And that's a tailwind that could actually last for years. Full self-driving subscriptions are also a piece of the story that deserves a lot more attention. Because the active subscriptions reached 1.1 million, up 38% year over year, and monthly subscriptions more than doubled during 2025. Now, the big structural shift here is that Tesla is sunsetting the upfront purchase option entirely and moving to a subscription-only model, which means this revenue stream becomes purely recurring. And if subscription growth keeps compounding at anything close to the current rate as the software improves, that's a high margin, sticky revenue base building underneath the volatile auto numbers. And it's the kind of revenue the market tends to assign premium multiples to. Now, the Robotaxi business is where the really big future optionality lives. They launched this in Austin in June 2025, started running driverless rides in December, and by January they were removing the safety monitor from some customer rides totally, which is a genuinely significant milestone. Now, the plan is to expand that to Dallas, Houston, Phoenix, Miami, Orlando, Tampa, and Las Vegas in the first half of this year, 2026. And the cumulative paid miles data, while still early, is showing an exponential curve. Tesla's argument is that they have something that no other autonomy company has: a fleet of millions of vehicles already on the road collecting driving data, a massive supercharger network, and a vertically integrated service center footprint that can support the operational side of such a ride-hailing business. So if you believe autonomy at scale is coming, that combination of assets is really hard for anyone else to replicate. Now on the product pipeline side, they have 6 new production lines ramping in 2026 across Cybercab, Semi, Megapack 3, batteries, and then the first Optimus production line. Cybercab and Semis are both targeting the first half 2026 for volume production starts, and Optimus Gen 3, which they're calling the first design actually meant for mass manufacturing, is being revealed this quarter. And the cash position to fund all of this is really strong at around $44 billion, with free cash flow at $6.2 billion in 2025, up 74% from the prior year. And then on top of all this, literally just this morning, Bloomberg reported that Tesla and SpaceX will be jointly building a chip fabrication facility that Musk is calling the Terafab. It'll be built in Austin to produce 2-nanometer chips for AI inference and robotics. And Musk's argument, which Bloomberg covered, is that the semiconductor industry isn't expanding fast enough to meet the chip demand that Musk expects from Tesla's vehicles, Robotaxis, Optimus robots, and xAI's infrastructure. So he's just going to build his own supply chain. And they're already developing custom AI5 and AI6 inference chips internally, and the AI5 is targeting a 50x performance improvement over their current AI4 chip. So if this actually works, it would be the ultimate vertical integration play for AI, but we'll see why the bears are skeptical of that in just a minute. Now, giving that bear case the same honest treatment, there's real skepticism about the future of Tesla. The core automotive business, which again represents 73% of Tesla's revenue, is declining. Total deliveries fell 9% in 2025 to 1.6 million vehicles. Automotive revenue dropped 10%. Model 3 and Y deliveries were down 7%, and the other models category, which includes Cybertruck, the Model S and X, got cut nearly in half at negative 40%. The new Model Y refresh helped in some markets, and APAC set delivery records, but those bright spots just weren't enough to offset the broader downward trend. And meanwhile, Chinese competitors like BYD and others have intensified to the point where Tesla is now the 3rd largest EV maker globally and not the first. The profitability picture is where it gets really concerning if you're on the bear side of this. If you're trying to, evaluate this as a business rather than just a story. The operating margins have gone from 17-ish% to under 5%. GAAP net income dropped 46% year over year, and return on invested capital is down at 2.5%. Automotive gross margins, excluding regulatory credits, sit at 15%, which sounds okay until you remember that number was 27% in 2021. All this while their expenses are increasing because of how much research and development they're applying towards the AI infrastructure and all their new product lines. So that spending might pay off eventually, but right now it's compressing already thin margins in a declining revenue environment. And then there's the valuation problem that the bears are focused on, which Bloomberg Opinion's Liam Denning laid out pretty clear in a February 13th, 2026 piece about Tesla being the odd one out in the Magnificent Seven. He pointed out that Tesla ranked dead last among Mag 7 in the S&P 500, contributing in 2025, and finished 22nd, and that Tesla's total free cash flow over the past 5 years is less than what most of the other Mag 7 companies generate in just a single year. He also noted that Tesla's planned capex for 2026, roughly $20 billion, will push free cash flow negative for the first time since 2018. All the while, that $20 billion budget is only about a ninth of what Alphabet plans to spend while still generating $34 billion in free cash flow. So the point isn't that Tesla can't become an AI giant, it's that starting from a car company is an extremely capital-intensive and low-margin place to attempt that transition, especially compared to the companies it supposedly peers with, the Mag 7. Next, we have the safety and the regulatory side, which also got worse this week. The NHTSA escalated its investigation into full self-driving to what they call an engineering analysis, which Bloomberg reported on March 19th saying that the agency identified 9 crashes where the FSD system appeared to fail in reduced visibility conditions, up from 4 crashes when they first opened the probe in 2024. According to Bloomberg's reporting, regulators found that the system didn't adequately detect when camera performance was degraded and didn't warn drivers in time. And this matters a lot because Tesla's entire approach to autonomy is fundamentally different from other companies like Waymo. Tesla uses cameras only with no LiDAR and no radar, and Musk has argued that since humans drive with visions, machines should too. And the advantage is that cameras are already built into every Tesla, which makes the system dramatically cheaper to deploy at scale. But the trade-off is that a vision-only system is inherently more vulnerable to exactly the kind of degraded visibility failure modes that the NHTSA is now investigating. An engineering analysis is the step before the agency can potentially seek a recall, so this is really worth watching closely for the automotive business. And then there's the execution and distraction question. Musk has been promising full self-driving next year since roughly 2016. Optimus was supposed to be available for purchase in 2024 and then 2025, and now we're looking at late 2026 at the earliest. The Terafab having been announced with no real timelines or cost estimates and no detail on when it might actually produce chips, despite the fact that building a chip fab from scratch typically takes years and tens of billions of dollars, and Musk having no semiconductor manufacturing background. Although we should say he probably has hired experts in that field to help not only him learn, but Tesla develop this production capability. And Musk being simultaneously running Tesla, SpaceX, XAI, and having been involved with Doge was something that has been listed in the risk factor of Tesla's annual reports, saying that they're highly dependent on services of Elon Musk, and acknowledging that he does not devote his full time and attention to Tesla. They put that in their own public filings. And of course, the short war continues. Gordon Johnson at GLJ Research has a $19 price target for Tesla. JP Morgan has $145. And on the other side, though, Dan Ives from Wedbush has somewhere around $600, while Kathy Wood has said that her most bullish estimate is upwards of $2,600, which is huge. The shorts have been wrong for over a decade on Tesla, and this war between the bulls and the bear has been costing the bears billions of dollars. But bears will tell you that the music will stop eventually. It doesn't matter right now, it's the fundamentals that matter, and they're worse now than they have been at any point during that losing streak the bears have been on. So where does this leave us? Well, Fincards, we don't make a call here. What we do is we give you the information so that you can make an honest decision based on the information provided. And I think the honest truth is that anyone who tells you they know exactly what Tesla is worth right now is bluffing. Because the range of possible outcomes for this company over the next 3 to 5 years is genuinely wider than almost anything else in the market. Now, the way I'd frame it is this. What would have to be true for each side to end up being right? For the bulls, you need Robotaxi to scale into multiple cities with solid unit economics, full self-driving subscriptions to keep compounding at over 30%, Cybercab and semi-trucks to ship on time and at cost, the energy business to keep its trajectory, and at least one of Optimus or the Terafab to show real commercial progress in a reasonable time frame. If most of that happens, then Tesla at $1.2 trillion market cap could look fairly cheap a few years from now. For the bears to be right, the car business needs to keep declining, the Robotaxi expansion needs to hit regulatory or technical walls, full self-driving subscriptions need to plateau, Cybercab needs to slip, and the massive CapEx ramp doesn't generate adequate returns. And if that's what happens, you're left with a declining car company trading at 300 times earnings, and that math gets very ugly very fast. Now, the specific things I'd be watching over the next couple quarters are the Q1 earnings, which are supposed to take place on April 28th, and particularly focus on the delivery numbers, the gross margins, and how CapEx is tracking against the roughly $20 billion annual target. track that full self-driving subscription count, because if it accelerates meaningfully past 1.1 million as they shift to subscription only, the recurring revenue thesis gets a lot stronger. The Robotaxi expansion timeline matters because if they actually hit 7 new metros in the first half of 2026, that's a real proof point that's hard to argue with. And Cybercab production is a real big one because that vehicle is purpose-built for autonomous ride-hailing, and if it starts on time, it fundamentally changes the Tesla story. When Q1 numbers drop on April 28th, the Fincards app will update that night, so make sure to check back in there and see how the pictures changed. Now, if you got something out of this video, please hit the like button and subscribe right now, and drop your take in the comments. I'm very interested in where you all land on this one, whether you're a Tesla bull or a bear, and why. I'd love to read your opinions. I'll see you next week with another deep dive.